Let's put some sense into what the macroeconomic readings were behind the latest Nigeria's inflation, sharply down to 13.34% last month. Year-on-year figure, but on month-on-month, which was 0.84% to the north. Both sides of the same coin of inflation. Let's get Michael Famoroti, who is the chief economist at Vertivo Capital Management, to weigh in into this news, just fresh from the press. Good morning, Michael. It's good to have you on the show.
Morning. Pleasure to be here as always.
Well, we love inflation any times when it comes in and it's heading south. Almost everyone likes it. But the first thing is, what's your initial reaction to these numbers?
The reaction is positive. It comes in line with our expectation of 13.3%. And in terms of the monthly inflation, it's roughly in line with what we expected as well. So what it tells us is that the path of disinflation that we were looking forward to is on track. And of course, that is positive. It's actually good to note that inflation has actually just hit a 2-year low. So the previous low was in March 2016 of about 12.8%. So we're making good progress on the disinflation front.
Michael, can we beat our chests and say we now have our hands on inflation and we've properly tamed it? Can the administration, can we do that? Can we say that?
Not yet. I think the moderation that we've seen has primarily been driven by base effect. The previous moderation that we saw, I think late last year, came from the fact that food prices started coming down. And that was the first step that was actually taken to ensure that we got a grip on inflation. But since then, the main change has been base effects. And if you look at month-on-month inflation, it's actually been quite sticky at about 0.8%, which isn't a particularly high level because if you analyze that, it comes to inflation of about 9 to 10%. But it does show that inflation or inflationary pressures aren't changing much. And the reason that the headline number is dropping is because of base effects.
Very quickly, what exactly do we mean when we say base effect?
Okay, so inflation is a year-on-year figure, i.e. it compares the prices this year to the prices in the corresponding month of that year. So, for example, in January 2017, prices were very high, right? So if prices were very high then prices now are still very high, but because you're comparing it to a pretty bad month already, it doesn't look that bad. So to use a quantitative example, the difference between 10 and 20 is 100%. So if prices went up from 10 to 20, then we say that we had 100% inflation. But the difference between 30 and 40 is also 100%. So it's also 10, but the percentage change is only 33%. So in that case, we will say that inflation was 33% as opposed to 100%, although the man on the street is still feeling the same price increase, but because the number that you are comparing it to is either bigger or smaller, the actual inflation figure that you get is going to be bigger or smaller. So it's more a statistical issue than anything.
Yes, I just wanted you to clear that properly for everyone before some folks get on social media, on Twitter in particular, and they start knocking me around and say, boasting, you're so happy on television that inflation has gone down, but the price of bread and sugar and tea remains essentially the same and the prices are even higher. So in case they just want to knock us, I just tag you in there and say, well, this is how to explain or understand it to the man on the street, because the man on the street is the one who's not interested about the statistics you and I talk about. But what do you think this administration, what is the macroeconomics behind this inflation really?
Well, I think our focus on two aspects. One is on monetary policy, and then the other is on the industrial base. So monetary policy has tried to get a grip on inflation. I think 2016, we saw a bit too much increase in the money supply, and that probably contributed to inflation. So we've been a lot more disciplined in recent months on the monetary policy front, and obviously the committee has shown a commitment to focusing on price stability. So that's one leg, and that's the leg that we got in just about right. But another primary reason for high inflation is
sorry, Michael. It looks like, Michael, just continue from there. You were explaining some of the macroeconomics behind the current inflation. Okay, I guess we lost him there. We're trying to reconnect with Michael there, the chief economist at Vertiva Capital Management. As you're looking at that, let's bring you that up. You can see the food sub index in March rose by 0.90% to 16.08%. We saw a bit of a decline there. If you pull that up again, you can see 17.59% at the bottom of that white a box on the left side of your TV screen. That's a year-on-year from 17.59% in February 2017, 16.08% in the bigger figure there. On the far right, you see a month-on-month, 0.90% from 0.85%. So you see that in food inflation, sub-index actually moved up slightly some notch from 0.85 to 0.90. And of course, most of the usual culprits responsible for that is the bread and cereals, the oil and fat, fruit and vegetables, fish, milk, cheese and egg, coffee, tea, and cocoa. Almost everything on my breakfast, lunch, and dinner table. So we're all part of that consumption. We see the food inflation slightly up. But year on year, it was a good story. But again, the macroeconomic issues behind this, as you've heard, is that this inflation falling, quote unquote, still about the base effect and not really much that the Nigerian authorities got their hands on the real drive of inflation. We'll have Michael Famuroti from Vertiva Capital back. Michael, thank you. We lost that due to internet disconnect. Let's continue to have your thoughts around the macroeconomic issues, what the administration should do to really get its hands on inflation drivers.
Well, I think just to keep it brief, the primary thing to do now is to focus on the cost of production in the country. And this is something that many business owners would be familiar with. So whether you're talking about power or transport and so on, it largely has to do with infrastructure. And when you can begin to address infrastructure, then you naturally reduce the cost of producing anything, whether it's farm produce or internet. So that should be the focus, and in some sense has been the focus. The issue, of course, is that it's a long-term play and is one that needs to possibly target specific industries and areas as opposed to just a general attempt at solving it.
Michael, does the market care about this inflation at all? Take it to the street for me, the market street, that is. The financial market.
I think the fixed income market will be closely watching inflation. I think there's an awareness in the market that over the next month or so, the MPC is coming to a sliding doors moment where they have to decide if they want to reduce interest rates or not. And obviously, that's a very big call for the fixed income side. So they will definitely be looking at this 13.3, which was below consensus, although it tracked our estimates. And it would be interesting to see, especially pending what the CBN does in terms of mop-ups, it will be interesting to see how the market trades today on the fixed income front. I think the equity market probably has its hands full at the moment and paid not so much attention to the inflation announcement.
Yes, if you look at the market yesterday, at the secondary window for treasuries, you see bills maturing next month around 12.9%. Is the market getting a sense of the fact that inflation will keep going down? And concerning the last MPC communique in which the new team says, look, we're holding on to a headline to all the parameters. We're looking at inflation very closely. We don't want to do anything for now.
I think the direction of inflation is clear to the market. It's going to go down. Perhaps the pace is a bit contentious, but what the market is looking for is, okay, what is the direction of interest rates this year? Is it down as well as people had expected, or is it just going to remain at 14%? And that's the final piece of the jigsaw for the fixed income markets at the moment, at least for this half of the year.
Yes, that's just where I was going with the trying to wrap up this conversation about your outlook for the rest of the year. It looks so good, 14th consecutive months. How long do you think we will be able to hold this rally on inflation, backtracking, moving to the final 9 months of 2018?
Well, for the first half of the year, base effects are our best friend because the base from H1 2017 is very strong. So it's just going to be dragging down the headline inflation. So we're likely to persist with this disinflation till the second half of the year. At that point, the other key parameters are one, election spending, which a lot of people would tell you can sometimes pressure inflation, but also if we see any, or if we do see the implementation of the minimum wage hike, then that is something that eventually would come into play on the inflationary front. So our view is that actually by Q4, as base effects peter out and as election comes in, then we may actually see a slight uptick in inflation.
Very, very interesting. Michael, thank you very much. Let's leave it at that for today. Thank you very much, the Chief Economist at Vertivo Capital Management, Michael Famaroti. We thank you as always for giving us your thoughts early as these numbers hit the